This is the trade commentary for the 4th of March, 2019. One of the most frequent questions I get from readers and subscribers is, how do I manage my trade? How do I know when to take a profit and when to let it ride? If a trade's going well, do I let it expire worthless, or do I go ahead and get out of the trade? Those are great questions, and I'll try to answer some of those for you right now. In the June 2019 class, I'm short 3 crude oil options right now. I'm short the 45 put and short both the 70 call and the 75 call in the June 19 class of options. I'm going to single out one of these trades for now and take a closer look at it. It's the 70 call June 19 crude oil. I sold it for 0.42, which was $420, about 58 days ago on the 2nd of January. Let's take a look at the chart so we can get some reference. Now, you've heard me say time again that this is a type of passive trading. It's not really a directional ploy. Back on January 2nd, I sold a 70 call. Oil was $50 a barrel. Even though it's gone up about $6 now to near $57 a barrel, there's still a profit on this trade. Now, there's still 73 days to go until expiration, so how did I decide to close this trade out? It's a no-brainer for me. I put up initial margin of $1,250 and 58 days into the trade. I made a 21.6% return in only 58 days. That's an annualized return of 135%. I like that. It's good enough for me. I'm not going to get greedy and risk my $270 trying to make another $150. I might wind up giving it all back. And I have done that on plenty of occasions. We all do it because we just can't tell the future, no matter how many times we think over the data on a trade. So at market open this morning, I'm going to see if I can buy this 70 call back for 0.15. If I can't, I'll drop in a GTC order at 0.15 or better for a closing purchase. Another thing about this trade, back on January 2nd, when I initiated the trade, it had about 131 days to go until expiration. Now, just to review, 58 of those days have passed and there's 73 days to go. So there's still a lot of time left on the trade. But doing a trade with a strike that's a little further out in time, though it may give us more time to have something unexpected happen, so we get more risk, we also have the opportunity to collect more time premium on the option. Now, one of the points I'm trying to make is just because a trader executes a trade that is out in time 2, 6, 4, 8, 10 months or longer sometimes, doesn't mean the trade's going to last that long. You're finding out we close the vast majority of these trades early, long time before expiration. I mentioned a moment ago that I have another crude oil trade that I'm shopping. This one, I'm switching charts on you now. This is the September 2019 crude oil futures. And I've stated for several weeks now that my view, fundamental view on oil prices, always subject to change, is that it probably is going to range somewhere between $48 up to $60 a barrel for several months down the road. And so I'm thinking about selling an 80 strike call and a 35 strike put. And you might be asking, why couldn't I take more money and sell a 70-40 or something a little closer in? The answer is simple. It's because I like to find the safest trade I can find for the money. And I think there's enough premium in this one to put it wide. Look at the distance between the 80 call and the 35 put on this trade. And you might try looking it up on your software if you don't have a lot of experience at this. Take a look at what the probability the options will expire worthless is. See how much premium you can collect. I just looked up the numbers on this one, and selling the 80 call 35 put right now requires $925, and I can sell it for about $300. So that's about a 30% return on this trade. And it sure looks interesting, so I'm going to be taking a look at that one later this week. This is Don Singletary, and thank you.